we are discussing today in our chapter on supply chain financing. And in the chapter, we're going to talk about various financing instruments that support the global fashion and apparel supply chain. These are the learning objectives that we intend to come across and be answered in the course of the chapter. And let's then start. A little bit about the evolution of clothing production financing. So, what once started as lending facilities to single regional government businesses has now progressed to secured and unsecured financing instruments that can accommodate borrowing. Okay, it can be via multiple vendors in multiple geographic locations throughout the global supply chain within the industry that we all belong to. Now, in supply chain, the decisions sort of have a rippling effect throughout the business. So, for example, let's talk about that a bit. Companies, they begin to move production further from their selling markets. Say when United States shifted their production to China. Now the retailers' cash situation was being stretched. Why? Because the length of time required to receive the goods pushed retailers to purchase greater amount of inventory to avoid any kind of stockouts. Okay, where in stockouts where we say that inventory is unavailable for sale. However, the purchase of this additional inventory excuse me, meant that a greater percentage of cash was being tied up. Obviously, when you buy a lot of inventory, you pay cash. So you are tying up amount of money in the form of cost of inventory for a longer period of time. So this is where your cash is being a bit tightened, and that a retailer would delay the purchase of equipment or delay any other investments that the retailer would want to otherwise make. So if you see the cash that has been invested in this inventory um, is now more at risk because of various reasons. It can be theft, it can be defects, it can be markdowns, are some of the few risk factors that are always associated with global supply chain. And hence we say the supply chain decisions can always have a rippling effect. Okay. Then we speak about financing that is required to fund different stages of production. Now, because of this global nature of supply chain, the type of financing instruments they need to evolve. They need to be addressing to international banking practices. It can be in terms of loan holders. It will also lead to increased risk due to longer production lead times or minimum orders, and also there is a overall volatility of the retail sector. Now with this scenario that we are in since last year, there is a lot of volatility to the retailer because they don't know how much they should order, and if the amount that they're ordering is going to be all used up, or will that be left out as a lot of stock or as a lot of inventory. Then the apparel supply chain, because of all these, has grown in complexity due to its movement from regional or local production to global vendor relationships. Okay. Then we speak about supply chain financing. So, as the nature of supply chain, it has become complex, like we spoke about it in last slide. There are too many financing instruments, there are too many terms, there are various sources of finance. So, the movement of production in this has resulted in extended supply chain networks involving business entities that typically had limited previous relationships. Now, to avoid that, and when you have production that has occurred in same shores, or financiers that were able to tighten the control by managing financing among common businesses within fashion industry, so that gave rise to supply chain financing. Now this was created by the financing community to support the various entities and financing needs throughout the global supply chain network. Now By definition, supply chain financing is defined by again the financing community, because as they are the ones who created it, as a short-term financing of buyer and seller working capital needs for supply chain management. Now, because this SCF, as it's called in short, financing is typically extended on the basis of receivable or on the basis of invoice that will be originated from one country but it is claimed in another, it needs the use of technology that can track and monitor transactions. Okay, so that is the key thing here. There needs to be technology involved as well. Even though if it is somehow not so old, this SCF, the practice is most commonly seen in countries like your US and Europe, and majorly in Europe, in the UK and Germany, which are more commerce focused areas. Because of this more traditional financing support that is offered in cooperative business structures, um, it has rather grown very slowly in China, in Asia, than in the other countries mentioned above. Okay, so ACF as such, what does it include? It includes credit products such as your warehouse finance or vendor prepay. It can be to do with pre and post shipment finance. It is also including buyer and distribution finance. So these financial instruments, they reflect the length of the borrowing need and the international aspects of the global apparel supply chain. So, how does the financing impact the global fashion or the global clothing supply chain? Now, because capital anywhere, any kind of business is the key resource that supports the financing of equipments, that supports buying of materials or paying for labor, the fuel used for transport of goods, the supply chain is highly dependent on a company's access to capital and cash flow. So, therefore, the way in which a company manages its capital, the way in which they manage their cash flow, it has a tremendous impact on the company's ability to meet customer needs, to pursue innovation, and to leverage its resources to gain a competitive advantage in the industry. Okay, we know there are tremendous benefits to the global supply chain as well, but there are also significant operating and financial considerations that might also have an adverse effect on the business. That can be, increase in inventory, um, that involves the length of time that is added to the production cycle for goods that is being shipped abroad. Then the cash reserves, because now there is this increase in inventory, which would mean that the company's cash is being tied up in financing its inventory instead of using it in some other form of working capital. So overall, there is an increase in inventory risk because of this lead time and because of this volume that is being committed to support the production abroad. So global production also means that a company is now vulnerable to currency fluctuations, it is vulnerable to any kind of geographical political considerations and supply chain disruptions that might also happen due to natural disasters. So that is why it is important to monitor the financial commitment and conversion cycle within a company. Then we discuss about how the supply chain's operations performance impacts finances. Now we know that clothing is primarily driven by the whimsical nature of consumers who often change their buying habits. It can be due to weather, it can be due to celebrity appeal, it can be due to lifestyle changes, and sometimes cost. Okay, so it is a challenge for retailers to predict in advance what does the shopper want. And also the internet, that is also creating an expectation that shoppers can actually shop anytime, they can shop anywhere and receive any kind of product that they want. So that is a bit tricky and difficult for retailers. So for these reasons, supply chain performance in the fashion industry has been forced to become quicker, keeping in mind the customer centric satisfaction and also keeping the price reasonable. Now, to protect this bottom line, companies, what are they doing? They are trying to place greater emphasis on the performance of supply chain. So We know that when everything is working well in the supply chain, it means obviously the company is going to be able to achieve consumer to consumer, cost to consumer, that meets profitable projections and ultimately customer expectations. So obviously the company is being in a profitable situation and the customer is getting what they want. Okay, but it also comes with a host of financial challenges that come up when a company is lacking supply chain operating efficiency. What else comes again? Retailers, they also make money by getting the right product to the right consumer at the right time. So when this fails to happen, there are what we call as markdowns. Now, these markdowns can also occur because the season is finished. It can be due to the weather pattern that was a bit off and on, or the consumer decided that, say, a straight leg jeans was out and flared jeans were in for the season. So there are various reasons for that to happen. So when that happens, a retailer is faced with inventory that isn't moving, and there are additional costs associated with the warehousing of inventory, coupled with the other lot of costs that the retailer has to bear. Now, this carrying of additional inventory also impacts the company's balance sheet. The company's reserves are tied up, and there is also a potential of inventory write offs due to this lot of inventory that is lying around. So that is what we have is stagnant inventory. Now, if we have stock out, if we don't have enough, now that this is where we have more than um, a where needed or more than necessary amount of stock, but we don't go for markdown, or we rather are in a stock out mode, which means there isn't enough inventory replenishment. Now there is a demand for the product, but the retailer is out of inventory, sorry, to meet the demand. So which happens? So then what do the retailers do? Most of the retailers, manufacturing outsourcing is, because for them outsourcing is done from Asia, the lead time that involves for garment production often doesn't meet the challenge of an unexpected increase in demand. So there is also a missed opportunity cost, and it involves consumers are disappointed and they don't want to go back and buy from these companies or retailers. But unlike most retailers, Zara reserves a significant portion of its merchandise selection that is open to be produced in season. So, keeping this portion of production open for your in season sales, that is what makes Zara flexible to meet the ever changing trends in fashion and at the same time the ever changing needs of consumers. Then, another area of production that has the potential to impact the company's financials is quality. Okay, quality of the material, it can be quality of the fit, it can be garment construction as such, because returns also represent a significant cost for retailers. So, quality management at the production level is very imperative, and a retailer's quality in general must also align with the expectations of its target market, so that we can minimize this major area of production that might affect the performance. Then, other than that, we have labor. Now, labor is also emphasized as a production cost, and there are several other supply chain costs that a retailer can also manage to impact its bottom line. The others would be your sampling, it would be pattern making processes. They are also key aspects of production that enable the retailer to test a garment for market acceptance and fit. So, making sure that we minimize on performance. Waste is also a part that incurs to the production cost. So, if you see in general, supply chain is vulnerable to financial costs. It can be also about theft. That is also one of the reasons. So, given that the supply chain often comprise or consist of third party vendors, international relationships, and also relationships with limited network knowledge, the global supply chain is highly vulnerable to the financial impact of loss. It can be from threat, it can be from fraud, which is very common nowadays. Companies can set up their own virtual platform and for fake and say that they are real and they exist and all of that, to realize that it was fraud and they were part of a theft. um, So the multiple parts of the supply chain, like your raw materials, production, and distribution, that create opportunities for shrinkage to occur throughout the supply chain. So one needs to make sure that as one moves further down the supply chain, there at least the finished goods that are in transit have been secured, and that they are not vulnerable to theft, and that there are insurance and systems in place to minimize any kind of negative impact that finances can have on the whole operations and performance in the supply chain. So in conclusion, we know that this complex nature of this global supply chain, it creates a need for funding throughout the various aspects of the supply chain, because of the lead time for production and the fact that majority of production occurs in Asian countries. There is a need for financing instruments and procedures to facilitate international trade. Now, the other area of financing that retailers must also consider is the impact on the overall cash flow of business. So which means, once again, the lead times involved would mean that companies might require payment prior to receipt of sales, and that is why early stage companies should often seek financing sources that can extend beyond just bank financing. So, the key for financing the supply chain is to make sure that these funding sources are able to support any kind of underlying cost that is involved in production. Okay, that's about it in the chapter. Thank you, everyone.